Good day to you, ladies and gentlemen. You would have noticed very recently when you go to a hawker center that the price of your kopi o as well as your cai peng and your economic rice have gone up very recently. Okay, and this is due to world events like the war that's happening in the Ukraine and rising interest rates that is affecting everybody around the world. So in today's session, I'm going to talk about what we can do to deal with inflation. All right, my name is Christopher Ng Chung. I am the Early Retirement Masterclass Trainer for Dr. Well. And today we're going to begin by talking about the key reasons for this inflationary environment. And then we will dive deep into the data to look at what inflation is currently like in Singapore. And we will start talking about what not to do when facing high inflation in the economy. And finally, we will talk about some of the remedies that we have in an inflationary kind of environment, right? Specifically, we'll look at commodities, banks and real estate investment trusts, and stablecoin yield farming. All right, so let's move on. The key reasons for inflationary environment is that mainly things are becoming more expensive as the war in the Ukraine rages on, and the supply of Ukrainian exports, right, like food. Ukraine happens to be a big exporter of wheat around the world, and as these exports get squeezed, the prices goes up. All right. Similarly, as economic sanctions are thrown against Russia, it is also causing a spike in oil prices. Okay, it doesn't help that the US Fed is now turning very hawkish. They are raising interest rates to fight inflation in the US, and this can raise the cost of financing around the world. Well, the combined effects of these world events will drastically change the game, especially for growth investors who've done very well in the past. Well, it looks like the folks who are invested in tech is not expected to do particularly well in the short or the medium term. So let's drill into what the inflation numbers look like in Singapore right now. Inflation in Singapore is spiking quite badly. Inflation about a year ago is only about 2.1%. Now we're talking about inflation at 5.4%. All right. Analysts have projected the Monetary Authority of Singapore to adjust the Singapore dollar exchange rate against other currencies upwards in October to fight inflation. But this can make our exports a little bit uncompetitive. All right. So that's the current state of inflation right now. And so I will begin by talking about what you should avoid doing in a period of high inflation. All right. Now, I know that for the people listening to me, there are a lot of fans of the Central Provident Fund, right? So a lot of people enjoy, and in fact, throughout the pandemic, have basically put a lot of their savings into the CPF accounts, right? Whether it is the OA, the MA, or the SA accounts. But do take note that right now, even if you consider the highest interest rate for the CPF special account, it only gives about 4%. And so if you were to put your money into something that gives 4%, it is actually guaranteed to lose, right, when inflation goes beyond 4%. All right, so that might not be a good thing to do if you, for example, like me, you're sole proprietor, and I have a tendency to make a choice to do a voluntary contribution. Okay. Now, the other bad idea are Singapore savings bonds and retail bonds, because the returns that you're getting is about, I think, 1.5 to about 2.5%. And similarly, if you put your money in these areas, you are likely to face a loss in your purchasing power. Finally, financial advisors and insurance agents like to sell short and long-term endowment plans, and these should also be avoided, right? Because the interest rate that you're getting is unable to catch up with the high inflation that we're experiencing right now. Okay, now this period of high inflation is expected to last quite long, as there is no quick fix to the problems in the Ukraine. All right, so the war is expected to stretch for possibly years, and unless Russia and the Ukraine can come down and start having some peace talks, right, these are not exactly the smart kind of investments that we should be making right now. All right, so with that out of the way, let's look at what we can possibly invest in right now. So the first idea I have for you are commodities. And commodities is generally an asset class where you buy industrial inputs, right? Industrial inputs could be metals, could be oil, could be pork bellies, and could be wheat. And one idea on how to make money with commodities is to simply buy a diversified commodity ETF like the Invesco DB Commodity Index Tracking Fund, or code DBC, that you can actually buy from a foreign broker like Interactive Brokers, right? For those who can only trade in SGX, there is only one ETF that is actually tied to the price of gold, and you can actually pick up a gold ETF by using the code O87. All right. So if you were to put your money into commodities, and as you can see, commodities have been going up since the war has begun. All right. And generally speaking, commodities actually can make you a little bit of money in a period of high inflation. The downside is that when there is no inflation, commodities generally tend to do quite badly. All right. But I think this time around, commodities, it looks like it's going through a secular bull market. So you should do quite well, and it's pretty hard to go wrong. All right. If you put your money into this ETF right now. The second idea I have for you today are the banks and the real estate investment trusts that are found in the Straits Times Index. All right. Now, local banks are expected to earn higher interest rates as interest rates edge higher. So this will always be the main story if you're looking at buying, for example, a diversified portfolio of 3 local banks right now. For real estate investment trusts, it is going to be slightly more complicated because it will try to exploit the reopening of the economy from COVID-19. But it is slightly riskier to get into real estate investment trust because if inflation rises too fast, it is impossible to actually pass along the inflation rate to the tenant. So your rental increases might not be able to catch on as quickly. So there might be a small probability of underperforming. You're able to combine banks and real estate together into a portfolio, you should be able to get, I think, about 4 to 5% dividend on an annual basis, right? In fact, for my program, a diversified REIT and blue chip portfolio can still yield about 6%, which will be slightly higher than the inflation rate that we're going through right now. So you have definitely a fighting chance to have your dividends being enough to basically overcome the high inflation rate at the moment. Okay. Now, for the folks that don't really want to complicate the process of stock picking, there are sufficient banks and real estate investment trusts within the STI itself. So the banks would be DBS, UOB, and OCBC. For the real estate investment trust, there is Ascendus REIT, Capital Integrated Commercial Trust, Mapletree Industrial Trust, Mapletree Logistics Trust, Mapletree Commercial Trust, Fraser's Logistics and Commercial Trust, and Capital DC REIT. Okay, so you can actually get your money and you get these 10 counters in equal shares, and you wouldn't do particularly badly in this regime. The third idea that I have are for the fans of cryptocurrency, and as it turns out, cryptocurrency isn't doing very well right now because cryptocurrency actually is positively correlated with equity markets. And as you notice, your tech stocks like Apple, as they drop, right, cryptocurrencies would not do particularly well either. However, there's a special kind of cryptocurrency called stablecoins that are pegged 1-to-1 against the US dollar. And here's the interesting thing about stablecoins, because they're denominated in US dollars, and the US Fed is raising interest rates. So there's going to be a rush and demand for more US dollars, right? When that happens, you notice that the US dollar is strengthening against the Singapore dollar. And so my students who's put their money into stable coins have actually made money from capital gains. Now, nevertheless, if you're able to put your stable coins into various yielding platforms like Crypto.com at 6%, Hodlnaut at 9%, and even Anchor Protocol that's currently yielding 18%, okay, you can actually build a fairly credible portfolio that could give from about 6 to 12% that doesn't actually have market risk. So this is actually a very, very good place for you to just hold on to your money, hopefully, and take advantage of stocks that are still dropping, and maybe do a little bit of market timing later if you believe in that. Okay, now do take note that because cryptocurrency is in the crosshairs of international regulation, it's a very new asset class. So please do not become too obsessed with the kind of high yields that you're getting, and try to keep your asset allocation to less than 10% of your net worth. All right, yeah, because the risk has not is still there, but it's been transformed into a different kind of risk, like regulatory risk and the risk of depegging. All right, so to conclude, inflation is going to flat foot a lot of investors. They'll be caught off guard because many investors in their 20s and 30s have not actually experienced this period of high inflation before. And the last time this has happened was actually in the 1970s, about the time when I was born. Okay, now investments in the past that worked like magic, like tech and growth, will start to fail, and a lot of investors would have to pivot to value strategies. That means moving into some kind of unfamiliar kind of terrain as they try to build a new portfolio. All right, so I hope that these investment ideas will shed some light on the things that you can do to deal with this high new economic regime of high interest rates and high inflation. All right, so that's all I have for you. Thank you very much.